Okay, let's go over options. Here's how to trade options a very simple way. Requested by a user in Twitch chat here. How to trade options a very simple way. We're going to use Tesla because this is the hype stock of the week as an example. So if you're trading options a simple way and you don't want to worry about all of the Greeks, all of the beta, the theta, all these different numbers that you don't want to think about, you just want to trade it based on the stock chart, then look at the stock chart. Find setups that you like on the stock chart, such as this breakout that we traded earlier this morning. Today is January 8th, 2021. Earlier this morning, we had Tesla pulling back from a big run yesterday, people taking profits out of the open, and then trending up, higher low, higher high, higher low, higher high, finally above the VWAP, setting a higher low above the VWAP. We took it over the previous high, stop under the previous low, and then target at these nice round numbers, 865 and a target at 875, PT1 and PT2. So that's your trade plan. You draw all of this in the chart before entering the trade. All of this you draw in the chart before entering the trade. And then right here, if you're on this candle over here, you see the breakout is about to happen. The breakout's about to happen. So you're here, this next candle is turning green. You're waiting for it to break over this level. So you then go over to your option chains. You think, okay, today's Friday. Simple rule, if it's later than Wednesday, if it's Thursday or Friday, don't trade this week's expiration date. Trade next week's expiration, next Friday's expiration date. So we're gonna trade next Friday. Very simple, you get the first out of the money call if you're going long, first out of the money put if you're going short. Out of the money lets it be a little bit cheaper for you, but it's the first one, so it's safe. It's not going to be extremely volatile. There's not a chance that it's going to expire worthless. It's a safer way of doing this. If you're not familiar with options completely, get the first out of the money call or put from the strike price right before you're about to get into the trade based on the stock chart setup. As you can see here, if we're talking about this candle, we're on this candle, we're looking, as soon as it breaks this candle, we buy it, we buy the call, however many calls you want to get. And then if it comes down and it breaks down under, it hits your stop level and it breaks down under the stop level, you sell your option. As if you're trading the stock, you sell your option based on the stock chart breaking down. If it comes up and it hits your target as it did here, this gray box is the first half of the trade, hitting first target, entry to first target. Once it hits the first target, you sell part of your holdings in the options. Once it hits your second target, you sell the remainder of your calls. So you're trading based off the stock chart this way. Very simple rules. If it's Wednesday or Thursday, don't trade this week's expiration. Trade next week. If it's Monday, Tuesday, Wednesday, then it's more than 2 days away. There's enough of a buffer until the upcoming Friday expiration that it's not going to have extreme volatility of people worrying about the expiration date, because volatility is a huge factor in options. Volatility factor. So when a stock's more volatile, option prices go up just inherently. Even if the price isn't moving a lot, but it's moving a little bit, but very volatile, very fast with high volume, then the option price will move up. And the option price changes much more significantly towards when it's closer to the expiration date. And it starts going down naturally because time is also a factor. Option prices get cheaper and cheaper and cheaper over time. That's why you could see next week's expiration is much more expensive than this week, because options get cheaper over time because of the time factor, decay. Because the closer it gets to expiration, the higher the risk that is going to expire worthless, that it's not going to hit this strike price. The higher the risk, the cheaper the option. And so just a very simple rule. If it's Thursday or Friday, don't trade this week's expiration, because the time factor is going to impact your trade significantly. If it's Monday, Tuesday, Wednesday, it won't impact it as much. First, strike price out of the money, and then trade based off of the stock chart. Very simple. If you are trading with a small account, under $1,000, I recommend trading just one contract per trade. This limits you so that you don't have to calculate oh, how many contracts do I get if my maximum risk is 2% of the account, but I have to multiply by 100 because there's 100 shares in each contract. You're signing a contract for 100 shares. You have to go through all these calculations. Instead of doing that to figure out how much you're risking per holding, per trade, just trade one option contract per trade. Keeps it very simple so that you're not over investing or over trading your capital into one position. If you have more than that, over 1,000, you can trade 2 contracts. And as your account is bigger and bigger and bigger, you trade more contracts per trade. It's a very easy way to avoid all the math of how much you're actually risking so that you don't invest more than 10, more than 20, more than 50% of your capital, whatever your personal rules are, into a single trade, because it's not good to invest your whole capital, your entire portfolio into one trade. Just in case that trade doesn't work out, you're going to lose a lot more than you should. That's part of risk management, is not just setting a stop loss and getting out at the stop level. That's risk management as well, but part of risk management is also limiting how much of your capital you invest in a single trade. And one way to do that with options and avoiding all the complex calculations, because that takes time, and that's time that might go by and make you miss a trade. Just simply figure out in advance how many contracts you're going to trade per stock, how many contracts you're going to get in the options when trading that stock chart. There's your quick lesson on how to trade options. If you have any questions in Twitch chat, let me know. If you have any questions on YouTube, post it in the comments, let me know. And if you're watching this on YouTube, I stream every morning on Twitch, 9:15 to roughly 12:30 Eastern time, every single day, every single trading day. So head over to Twitch, twitch.com/𝗏𝗏 to watch my trades live, to watch my lessons live, to ask questions, etc. Quick question towards the end. Don Hall is asking, what is expiration day? Expiration day is the day that the options expire. An option is a contract for 100 shares of a stock, and the contract expires on the expiration date. So you can see you have an option chain here. You have an option chain here of different expiration dates. You have weeklies, you have monthlies, you have quarterlies. All that's extremely complex. Don't worry about that. We're focusing on weeklies for day trading. The options for January 8th weeklies expire today, meaning if you're holding an option and it's out of the money and you don't sell that option, or you don't exercise it to get the 100 shares per contract, it'll expire worthless and you lose your money. Whatever you paid in premium. Your premium is the cost of the option, like right here, $840 on the ask times 100. So this would cost $840, $845 now for premium to purchase this option. And if you let it expire on its expiration date worthless, you lose that $840. Any other questions? How do you know what's in and out of the money? What does that term mean? That means that the option contract is in the money. These blue here, this is in Thinkorswim by TD Ameritrade. The blue is in the money, meaning the stock price is, for the calls, the stock price is over these strike prices. So these strike prices are the stock prices. So 870, you can see here, this strike is 870. That's the contract you're purchasing, is you're purchasing 100 shares. The option, that's why they're called options, the option to convert your contract into 100 shares of Tesla stock at $870 per share. Right now, you can see up here, Tesla stock is at $878 per share. So if you exercise your contract, you will get 100 shares at $870, and you automatically get that $8 return on your investment. Because you're exercising your contract for shares at $870, you get those shares at $870 right now, even though the price is $878. And so if you're in the money, that means the price is higher. If you're in a call, the price is higher. You are in profit. If you have a put right now, let's say you have an 870 put, it's at 878, roughly, the stock price. If you have an 870 put, that's out of the money. If you were to exercise your shares, your contracts, excuse me, if you were to exercise your contracts to get 100 shares per contract at 870, you would be $8 at a loss, $8 per share. So that's out of the money. What broker? This is TD Ameritrade that I'm using. Are the shaded areas in the money areas? Yeah, the blue ones are in the money on this. Any other questions? Very simple option trading lesson. Very quick. It gets more complex. If you really want to take option trading to a new level and you really want to make consistent profits, I can coach you on option trading. I can mentor you on option trading. You can take the 0 to 1 trading course and learn all of these things. How much does it cost to place a trade? The cost is your premium. Your premium is the price you see here of the contract times 100. So if I were to click buy on this, 880, it would cost me 890 now. 890, $8.90 is the cost of this contract, right? So how much I pay for it is $890 because it's a contract for 100 shares. So this is $9 per share. So that's your premium. That premium is your maximum risk in an option trade when you're purchasing options. So if it expires worthless, the most you could lose is that premium, that 800 whatever in this case. And your potential reward is infinite because the price can go infinitely high, of course. Again, options get much more complex than that. It takes a lot more experience. You're not going to trade options consistently and profitably just from that lesson. That's just enough to let you understand what's going on when you're looking at these things. When you're looking at a chart, when you're looking at an option chain, you know what's going on so that you can at least start practicing. I recommend practicing. If you don't know how to trade options, practice in a paper trading account. Practice paper trading first. Practice with very low size. No, you cannot buy less than 100 shares. Option contracts are always 100 shares per contract. But Tesla is a very expensive one. Tesla is very expensive. If we go to a much cheaper stock, let's go to something like a Lemonade. Much cheaper stock, 1/8 the price. Here's this stock price now, 167. Not exactly 1/8 the price, but rounding. You can see that the contracts right now are around $2. So that's $200 premium. If you go to something, what's a cheaper stock right now? We can go to AMD. AMD is at 94. You can see 21 cents. So this would be $21 of a premium. And even though this share price is not far off of what we just looked at with Lemonade, I mean, it's decently far off, double, but much more. It's 10 times the option price because of volatility. This is up 9% today. Lemonade's up 9%. That's high volatility. Volatility is a factor in options that increases the price. When there's high volatility, option prices get higher. And so in AMD, it's half the share price, but 1/10 the option price because there's no volatility today. It's pretty much break even. This white dotted line is yesterday's close. It's only down 0.7%. Not very volatile. You buy out of the money and wait until option goes into the money, then exit or sell. Not exactly. Why I say in this very basic lesson to buy the first out of the money is because out of the money is cheaper. So it's a little bit cheaper, but it's the first one out of the money, so it's not that much risk. Because really what you're looking for, let's go back to this Tesla trade. What you're looking for in this one, all you're looking for is the price to go up. If a price goes up and you're in a call, you'll make money. I mean, that's not guaranteed. There's other factors again. But if the price goes up, you assume the option price will also go up if the stock price goes up. So here, we're going to look at buying in this trade the 855 strike price with a target at 865. So if we buy the 855 strike price, which there isn't even one, so the next out of the money one would have been 860. We would have bought 860 here and sold the 860 one when it reached 865. So it would have then become in the money, yes. But it's not always, it's not buy out of the money, sell in the money, buy out of the money, sell in the money. You don't have to do that. You could buy 3 strikes out of the money and sell when it's only 1 strike out of the money, because the price got closer to that strike price. These blue ones, they change when the price changes. So like if the price breaks $880, then these options right here will be blue, because this is the 880 strike, and that will then be in the money. It's the same as stocks, where you're just buying low, selling high. But instead of trading the stock, you're getting the options because let's say you don't have as much capital in your account, and so you can't buy shares of Tesla stock. Now Tesla options right now, because the volatility is so high, Tesla options are also really expensive. Let's go back to like AMD. Let's say you can't buy 5 shares of a $94 stock, but you can buy 5 contracts at $22. See how that kind of works? It makes it a little bit cheaper for you. And that's why a lot of people that over this past year have gotten into option trading, because they have smaller accounts. It's a lot of newer traders, and they want to trade smaller size. Do you know how long I wanted someone to break this down for me? I'm really happy. I'm glad that this made sense to you. If you have any more questions, please ask. I'm going to clip this, make a highlight of this on Twitch. I'm also going to post this on YouTube in the near future, so you can watch this over and over and over again, take notes, ask me questions, post it in the comments, ask me in chat here in Twitch. So again, thank you for everybody who listened to this lesson. If you're watching this on YouTube, I stream on Twitch every morning, 9:15 to 12:30 roughly Eastern time. Every single morning that the market is open, unless something's going on in my life, of course, all things considered. And I live stream trading. I'm not going to give you trade callouts, but I'll teach you just like this lesson about options. I'll teach you how to trade, because that's my passion. My passion isn't to just feed you a bunch of trades. My passion is to teach you how to trade so that when I'm not around, when I'm not live streaming, you can make your own trades. I don't want you to rely on me. I want you to learn from me. So head over to the stream